When am I supposed to stop? 9. 9 UK Nigerian time. Nigerian time, 9 UK times. Okay, I have 1.5 hour. All right. All right. Okay. Okay. Top right. So we'll be looking at IFRS 9. So basically, I will just tell us what the objective of IFRS 9 is. IFRS 9 is talking about non-current assets held for sales. IFRS 5, sorry. IFRS 5. So IFRS 5 is talking about non-current asset held for sales or discontinued operation. So when you say non-current asset held for sales, that means something that is what? Held for sales or discontinued operation. So one of the objective of this standard is to know how to classify asset that non-current asset that are held for sales. How do we measure it? Then what is the presentation in the financial statement and what is the disclosure requirement? Don't forget, I told you that anytime we are talking about measurement, we are saying that at what amount or cost or price should be displayed in the financial statement. That is what is meant by measurement. So the first one we're going to be looking at is classification. So IFRS 5 have certain conditions that need to be met before an asset can be classified to be said this asset is held for sales. So the number one is that the item is available for immediate sales in its present condition. That means as at the time that asset is available, we don't need to do anything on that asset. Is readily available. Number two is that the sales is highly probable. That means it's very certain that we are going to be able to sell that asset. Number three is that the company or entity management is committed to plan to sell them. That means you must be willing to sell. The next one is that there is an active program to locate a buyer that has been initiated. That means there must be a kind of a marketing strategy that is in place to make sure that yes, people buy the assets. The next one is that the item is being actively marketed at a reasonable price in relation to the current fair value. That means the price at which we want to sell the asset must be reasonable. We can't just want to sell something that worth 10,000 for 100,000. I'm not sure how true this thing is. There's this particular bread here. I think maybe they call it boucher or something like that. They sell the bread for £1.69 in Asda or Audi. Asda. And I was seeing that somebody said they are selling it for 25,000 Nigeria. And I was wondering, like, £1.69 is about, let's say, 3,000 or something. So how can they be selling? So I was wondering why they wanted to. I was wondering why they wanted to sell that bread at that high rate. That's number one. Number two is the fact that that bread it contains a lot of sugar. For me, my own opinion. So there must be, that means the price at which you want to sell that particular item must be reasonable. The sale is supposed to be completed within 1 year. There is an exception to this one. We expect to make that sales within 1 year, but there is always exception to this. It is unlikely that the plan will change significantly or will be withdrawn. So this IFRS 5 require all these conditions before we can classify an asset to be held for sales. Okay. The next one we want to look at is what we call measurement. How do we measure an asset that is held for sales? An asset that is held for sales is actually measured as lower of carrying amount or fair value, less cost to sales. Where fair value less cost to sales is lower than the carry amount, then the item is written down to the what? To the for an impairment loss. We have talked about, I think, impairment loss before. If a non-current asset is measured using evaluation model and it meets the criteria to be classified as held for sales, it should be revalued to fair value immediately before it is classified for held for sales. It is then revalued again at the lower to the carrying amount and the fair value less cost to sales. So what it means is that we talk about revaluation model and and fair value model, which is the cost model, when we are talking about under IAS 16 PPE. So we are now saying that if the asset we are using evaluated model for that particular asset, then it should be what? It should be revalued to what? Fair value. When a disposal of a group is being written down to fair value, less cost to sales, the payment loss reduce the carrying amount of the asset in order to what? Are described by what? IAS 36. Again, can be recognized on any subsequent increase in fair value, less cost to sales, but not in essence of the what? Cumulative repayments. We can have a gain, but it should not be more than the cumulative repayment loss on that particular asset already recognized. An asset held for sales is not depreciated, even if it is being used by the entity. So if an asset is meant to be held for sales, we cannot depreciate it, even we are still using that particular asset. The next one we want to talk about is presentation in statement of financial position. IFRS 5 states that assets classified as held for sale should be presented separately from other assets in the statement of financial position. The liability on the disposal of a group classified as held for sale should be what? Should be presented separately from other liability in the financial statement as well too. Then major class of asset and liability classified as held for sales must be separately disclosed, either on the face of financial statements or to the note to the account. Where an asset or a disposal of a group is classified as held for sales at the reporting date, but before the issue of the financial statement, details should be what? Disclosed. We must always state it. This is a non-adjustment event after the reporting date in accordance with what? IAS 10. What if there is a change in plan to sales? If a sale does not take place within 1 year, I5 says that that asset can still be classified as held for sales. So we intend to sell an asset, and we said that for an asset to be held for sales, in our first slide, they said it must be sellable within 1 year. But what if we are not able to sell within 1 year? Can we still classify as that asset as held for sales? Yes. The delay has been caused by events or circumstances beyond the entity control. That means if the delay is not within our control, there is sufficient evidence that the entity is still committed to sell. There are steps, we are taking steps to make sure that yes, we want to sell that asset, except on this condition. If the criteria for held for sales is no longer met, then the entity must cease to classify that asset as what? Held for sales. They will take it back to what? Non-current assets. So that is that. And the last one we want to look at before we look at illustration is disclosure. Right? So in the period in which non-current asset or a group of assets is classified as held for sales or sold, IFRS 5 said the entity must what? Disclose. 1. Description of the non-current assets, description of the fact or circumstances for the sales, and the impairment loss or reversal recognized. So we must always disclose it. These are just the disclosure requirements. Anytime we are talking about disclosure requirements can be in a two-way thing, can be in a form of note to the financial statement, additional note to the financial statement, can also be in a form of how we present it in the financial statement, how we stated it in the financial statement, maybe on the face of financial statement. That's what the disclosure requirement always means. All right. So let's look at knowledge check. Knowledge check. So we want to read for us. Knowledge check number 1. We want to read for us. Can you still see my screen? Because I just put it in a slide mode.
Okay, let me read. Yes.
Can you see my screen?
Yes.
Right.
Can I read?
Yes, go ahead, please.
Sandra is preparing its financial statements for the year ended 31st December 2007. A. On the 1st of December 2007, the entity became committed to a plan to sell surplus office property and has already found a potential buyer. On the 15th of December 2007, a survey was carried out and it was discovered that the building had dry rocks and substantial remedial work would be necessary. The buyer is prepared to wait for the work to be carried out, but the property will be sold until problem was the problem has been rectified. This is not expected to occur until summer 2008. Required. Can the property be classified as held for sale? B.
Can we look at A first? Let's stop there. Let's look at A first. Let's attempt the A first. Am I muted? No.
No, we can hear you.
Okay. Let's look at A first. Who want to attempt? Or do you want me to attempt it? Who want to attempt? Can the asset be classified as held for sales? Sandra is preparing its financial statement for the year ended 31st December 2007. On 1st of December, the entity became committed to a plan to sell a surplus office property and has already found a potential buyer. On 15 December 2027, a survey was carried out and it was discovered that the building had dry rots and substantial remedial work would be necessary. The buyer is prepared to wait for the work to be carried out, but the property will not be sold until problem has been rectified. This is expected to occur until summer 2028. Required. Can the property be classified as held for sales? So, in attempting this question, if you look at one of the first requirements of classifying an asset as held for sales is that it must be readily, immediately available for sales in its present condition. Classification, the item is available for immediately sales in its present condition. So we look at that particular condition. Does it exist here? Is this asset immediately available for sales in its present condition? Yes or no? Yes or no?
Yes.
How?
At its present condition.
Yes, is it available in its present condition?
It cannot be held for sales because there is a dry rot in the land. It's just that the buyer is ready to wait until the problem is rectified. But at present now, 2027, it cannot be held for sales.
So what will you classify it as?
Thank you.
So yes, you are very correct, because as at that date, it's not available because it's going to be available on 2027. So we can't classify it as S for sales because there is the need to carry out remedial work on that particular set. That is the reason why we cannot classify it as head for sales. Does that make sense?
Yep.
So can we look at the B part?
Okay, the B.
Yeah.
B, a subsidiary entity B.
Sir, you did not answer. What will it now be held as? Will it just be assets in our book?
Definitely, it's going to be. Once we can't classify it as head for sales, they will become an asset in our book. That's what is going to be classified as.
Okay, thank you, sir.
Yeah. So I'm just telling you the reason why it can't be classified as head for sales. And once an asset cannot be classified as head for sales, then it becomes a non-current asset. So let's look at B. Any question before we look at B, please? Any question before we look at the B part?
No, sir. Let's continue.
Okay. All right.
A subsidiary entity B is for sale at a price of $3 million. There has been some interest from prospective buyers, but no sale as of yet. One buyer has made an offer of $2 million, but the directors of Sandra rejected the offer. The directors have received advice from their accountants that the fair value of the business is $2.5 million. They have decided not to reduce the sale price of B at the moment. Required. Can the subsidiary be classified as held for sale?
So what do you think? What do you think? What do you think? What do you think? So a subsidiary entity B is for sales at a price of 3 million. There has been some interest from prospective buyer, but no sales as of yet. One buyer has made an offer of 2 million, but the director of Sandra rejected the offer. The director have just received advice from the accountant that the fair value of the business is 2.5 million. They have decided not to reduce the sales price of B at the moment. Can the subsidiary be classified as held for sales? I mean, what do you think? I mean, what do you think?
It should be classified as held for sale
Why? There must always
because
be a reason.
yeah, there have been potential prospective buyer, like they showed interest. It's just that um they are not giving the price that the company wanted to buy it.
So that's
Yes,
the reason
that's
why
the
we should.
major reason.
Sandra, what do you think? Sandra, what do you think? Sandra, what do you think?
Yes, sir. Can you hear me now?
I can hear you now. Yeah,
Okay. For that question, my
yeah.
own opinion is it cannot be held for sales.
Thank you.
My
Why?
own reason is because of no consideration. They have not been able to agree on a fixed price. I think that's the reason. But I did not see audio condition because I came in late. Apologies
Okay,
for that.
I'm showing you the
But
condition
that's just
now.
my reason.
I'm showing you the condition. These are the
Okay, let me
conditions. These are the conditions.
use. This is high book. Management is committed to make plan to sell the item. An active program to
Just to answer Amina's question, why you are reading, Amina, why I will not agree with you is that management must be committed to a plan to sell it. But in this scenario, management is not committed to sell.
I think that is the only criterion that fits. The criteria that I have in my head does not even fit.
So what do you not think? What do you not
I
think?
think it can be.
It can't be. Why? Why can't it be aired? Is it because management is not committed?
Because of the managed condition.
Mr. Upoli, what do
The
you think?
management are still.
Mr. Upoli, what do you think? Mr. Upoli, what do you think?
Say, sorry, it was a mood. Just as she said, there is no consensus to sell the item.
Okay. Yeah. Number one thing I will say, I will answer this question in two ways. Number one thing I will say is that apart from the fact that management is not committed, right? But there is a potential winning buyer that is willing to buy, but management is not committed. Because of that, can we say that yes, that asset should be classified as held for sales? Because the management that is not willing to sell, but a potential buyer is available. I've not answered the question. No, I'm just saying no.
Yes, sir, but wait, even though you see buyer and then the management are saying they are not
They not agree to us to sell it.
then you can't buy it now. It cannot be held for sale.
Yeah.
Because even the management, they have not decided, they've not fixed what they will sell it at.
Thank you.
Because management is not agreeing, it cannot be held for sale.
Thank you. It cannot be held for sales. One thing you should also realize about this held for sales is that all these conditions must be met. If one of the conditions is not met, if management is committed to sales and there is a potential buyer but they are not making, there is some of this condition is missing in the question they gave you, then you cannot classify it as head for sales. So all these conditions must be what? Must be met, except where we have exception. Like the sale expected to be completed within 1 year, it must be there. If they expect to complete the sales in more than 1 year, we cannot classify it as head for sales because it's no longer is now becoming useful more than 1 year, except in certain condition that we put there. There are exceptions to that. That means if delay is caused by events that is beyond the entity control, or there's evidence that yes, the entity is still committed to selling. So in this scenario, we cannot classify it as what? As head for sales. Okay? Does that make sense?
Yes, sir.
Let's look at knowledge, check knowledge 2. Who want to read for us? For 2.
Let me read, sir.
Okay.
Check knowledge 2 says on the 1st of
Before you
January
continue,
2021.
just a minute.
Okay.
I don't actually like the fact that people use sir for me. You don't even know whether I'm younger than you.
Ah! Ọmọdé lásán like me, sir.
But that
Please,
is just the fact. I think it is
He's
yeah,
the way
but
to know.
that's my
Just
policy.
check him. His name is FCA. So when you see FCA, how do you know with FCA? You know how long it takes to get FCA. When you become a T, you have to wait 10
which
years
day did I say
practice to get FCA.
that life I will not
In
sir
fact,
in your
when
name?
the tutor is in the class, definitely, it's just a form of okay. At least for this class, so
But
let's
sir,
accept this.
does not actually connote respect. Personally, I don't actually really like it, to be honest with you. But Moses, to be honest with you, how do you address your partners?
I just say call them by name now.
We call them by
Yeah,
names now.
Yes.
So we call them by name. So because you call them by name does not mean that you are disrespecting them.
Yeah, sure.
So sir is not a
In fact, you don't even use star in the office.
you
Yes,
don't use
that,
sir,
but
yes.
you should also need to consider the environment too.
Irrespective of the
No,
environment.
our own culture is
Because
different
back
from
home,
your
we call
culture.
our senior sir. You can't call them by name.
See,
Except some organizations, they prefer you call them by their name.
my
But
CFO,
mostly,
is 67. The first time I wanted to send him an email, I used sir. You know, he called me to say, why are you putting sir in the email? Because I'm actually putting sir there because he's actually an elderly person. So I was like, this man is 67 now.
In fact, Mr. Badru, the bad thing is that if you use star or ma for them, they get upset. You know why? If you make them feel as if they are old, as if they are going to die soon.
So
Just they hate it.
I have to like, okay, he had to come into his office to say I should never use sir in my email in addressing him again. But apart from even that, I think personally I don't like it. That's the truth.
sorry, but when you are growing up, you are calling your boss sir.
You are still saying sir again. I think if I'm in the class, so I think that's what I would prefer. You just call me my name. I prefer that. Is that you don't use sir, or you just answer the question straight away? I'll be okay.
We cannot be loud.
Sir, I won't be comfortable, honestly. Sir, I won't be comfortable.
Just asking the question without using sir.
That means we will not be able to be answering questions in your class.
It won't
And we
flow
like your
very
class
well.
to be interactive. You have to allow us to flow. We are coming from another culture. Hey, Josa.
People in Nigeria can't be calling your God name. Just say, dear, your God name. Unless if you still remain there in 1 month time.
You will be teaching us what will take us to jail.
Please, for the sake of this class, let's call you for that, sir, please, so that we can flow well with you. For the sake of the class, please.
Also, Mr. Badru, you know how we need to call you sir. Are you there? Is everyone there?
Yes, Sandra. Oh
We
yeah,
are
now.
here.
When I was doing my ICANN induction, yeah, the FCAs were there, and they told us that day that these are your seniors. That when you see them, you have to give them maximum respect. You have to make sure you bow to them, you bend. They told us everything that day. In fact, they gave them FCA before they give us ACA that day. So when you see FCA, you have to respect FCA. By the time I become FCA now, even I'm in answer that I'll not be able to see my face. I'll be strong in my face for everybody. Don't mind me, I'm just kidding. No?
Okay, can I read?
Yes, please.
Is
Mr.
this
Badri is
Mr.
not talking, no.
Ah,
It's not responding. Probably maybe it's network connection or
Okay.
internet.
But do you know that everybody, Amina is my senior colleague? Oh, do you know?
No mind Moses.
Amina became a CA before me. Oh. Amina became a CA like 2012 or 2014 or so.
Hello,
Mr. Badru,
sir.
we are here.
don't say so. Oh. Mr. Badru, Amina is my senior colleague. Oh, do you know?
I don't know.
Amina
Let's not
became
start
a
that one,
CA
beg.
in
Sandra, please,
about
can you?
2014 or
Let's not start
thereabout. Oh. She's my senior colleague.
stuff.
Ah,
Sandra, please. Oh yeah, now move on.
So I'm supposed to be respecting now.
no problem.
Oga Moses, now allow Sandra to read.
Okay, sorry, ma.
Okay, back to reading. On the
Yeah,
1st of January 2021,
can you see my screen?
screen.
Can you see my screen?
Yes, so but it's
Yes, I
not
can see
Yes,
it now.
mode.
yes.
On the On the 1st of January 2021, AB acquired a building for $200,000 with an expected life of 50 years. On the 31st of December 2024, AB puts the building up for immediate sales. Costs to sell the building are estimated at $10,000. Required, outline the accounting treatment of the above if the building has a fair value at 31st December 2024 of A 220,000, B $110,000.
All right. So what happened in this scenario is that AB actually had an asset, a non-current asset that was used, and they will now want to edit for sales. It was probably not edit for sales. Now they want to edit for sales. So AB acquire land and acquire a building for $200,000 with an expected life of 50 years. On 31st December 2024, AB put the building up for immediate sales. Cost to sales are estimated to be 10,000. Required, outline the accounting treatment of the above if the building had a fair value of this amount and this amount. The first thing we need to do is to calculate what is the carrying amount as at the time that asset is actually held for sales. What is the carrying amount as at the asset is held for sales? So for us to do that, permit me to put up uh permit me to put up an Excel. Did I promise I was going did I share the Excel of yesterday? No. Yes.
No, Mr. Badru, you didn't even share the PDF, so and the document, you didn't share them.
Can I share it through this platform or I can share it to you? No. Yes.
You can share to me. Also, the one for last week, you did not share too.
The Excel or the PDF or which
The
one?
PDF, all of them. There's only once you shared to me, which is the
Okay.
first one you took the first time.
Okay. I will share all of them. Okay. Can you see my Excel?
Yes.
Okay. So the assets, cost of building, the building cost $200,000. Let's see, can hit up to that. Permit me to use pounds. So the building costs $200. Useful life is 50 years. Right? 50 years. So the first thing we want to look at is that at what point in time was this, as at 1st of January 2021, AB acquire a building? It was acquired in 2021. Date of acquisition. Oh. Dates of acquisition. That is 2021. 2021, right? So basically, the first thing we want to do is to calculate carrying amounts. To get our carrying amount will be the cost divided by useful life. I'm sorry, the first thing we need to calculate is to calculate depreciation. Our depreciation is going to be the cost of the assets, right? Divided by 50 years. So that means, as for each year, depreciation will be $4,000, right? And the asset has been used for 2021, 2022, 2023, 2024, if I'm correct. Date of on 31st of December, that's the date they want to put it for use. That means total depreciation on these assets will have been times 4, 16,000, meaning that carrying amounts is equal to cost of the assets minus accumulated depreciation. Does that make sense? And we said earlier that measurement of asset held for sales, any asset that is held for sales should be at what? Lower of carrying amount or what? Fair value. Any asset that is held for sale should be at lower amount or fair value. So in this scenario, we have the fair value to be 220,000, right? Fair value is 220,000. So the requirement of this question is to say at what cost. Outline the accounting treatment of the above if the building had a fair value of A, 220,000. So in this A option, the fair value, I need this. The fair value is 220. The carrying amount
You need
is
less
one.
cost to sell from the fair value,
What this?
Abi?
Cost to, do we have cost to sales?
Yes.
Yeah, we have cost to sales. Cost to sales is
10,
10,000. Thank you. Cost to sales is 10,000. Cost to sales. Cost to sales. That's 10,000. Shift it down. Thank you. Cost of sales is 10,000. So no. Yes, I know the cost of sales is 10,000. Let's go back to the question. The question said, outline the account treatment of the above if the asset has a fair value of 220,000 and 10,000. I want to add to this question, right? I want to add to this question. This one is, I'm fine with this, right? Okay, don't let me add to the question. I will still ask my question later. The 10,000 is given, cost to sales is given, right? So which cost are we going to recognize? Are we going to recognize fair value or carrying amount? Are you going to recognize fair value or carrying amounts?
Carrying
Are you going to
amounts.
recognize fair value or carrying amounts? Carrying amounts, because the carrying amount is lower, right? Because
Yes, it's lower.
because
Yeah,
the carrying amount
it's
is lower.
lower.
Yeah. Yeah.
But eventually, let's leave it like that. In option B, we are told that the fair value is how much? That's option B. Fair value is 110,000. So in option B, 110,000. Which cost are we going to recognize? Carrying amount
Fair
or
value.
fair value?
Fair value.
Fair
Fair
value, fair
value.
value,
That means
fair
in
value.
option B, we pick fair value. In option A, we pick carrying amount. But if
Yeah.
potentially, technically, at the end of the day, our carrying amount is going to be 183. Let's say 183, 174 here and 100,000 here. Do you agree? Because of cost to sales of 10,000.
Okay.
Technically,
Yeah.
Yeah.
that is if we are determining our gain on disposal. That's when we take this one into consideration. That's why I did not take it into consideration now. If you need to determine our gain on disposal, technically, this our carrying amount will eventually become 174, and then it's going to become 100,000. But what they're asking us is which one is lower between what is the accounting treatment? Basically, accounting treatment, we are going to pick the lower of the carrying amount of fair value. But ultimately, our carrying amount in option A is going to be 174, while here is going to be 100 because of this cost of sales, because we need to let cost of sales before we get our profits on disposal or gain on disposal. Does that make sense, please?
Yeah.
Okay. One more question. Do we have impairment loss here in any of this option? Do we have impairment loss in any of this, in any of the option, whether in option A or option B? We talk about impairment loss. Do we have impairment loss in any of the two options?
For B, we have impairment loss.
How much is our impairment loss for B?
It's 74. That's if you are using 180 as a carrying amount.
Yeah.
74.
Yeah, 74, right? So that impairment loss, where are we going to charge it to? OCI or P or L?
OCI.
OCI, thank you. So in option B, there is an impairment loss. There is impairment loss in option B, and it's going to be charged to our OCI. Thank you. I really appreciate that. All right. So let's go to knowledge check 3. Who want to read for us? Any question before we go to knowledge check 3, please? Any question? Any question?
Okay, the question I wanted to ask is this. So why are we not outrightly deducting the cost of sales? Why are we not deducting it?
Where is the cost of sales? Okay, why are we not actually you can deduct the cost of
Yes.
sales? You can deduct it because the
Okay.
question did not actually give us further what is the selling price, but you can deduct it. Yes, you can go ahead and take away the cost of sales from it. So potentially it's going to give you 100,000 in option A, and
Yeah.
I think 174 in option B. 100,000 in option B and 174 in option A. Yes, you can.
Okay.
You want to read this one for us, please? You want to read for us?
Okay, let me read this one again. Can read it.
Yes, go ahead.
Lorry purchased a building for its own use on the 1st of January 2021 for $1 million and attributed it a 50-year useful life. Nash uses revaluation model to account for buildings. On 31st December 2022, the
Continue.
on 31st December 2022, this building was revalued to $1.2 million. On 31st December 2023, the building met the criterion to be classified as held for sale. Its fair value was deemed to be $1.1 million, and the costs necessary to sell the building were estimated to be $50,000. Larry does not make a reserves transfer in respect of excess depreciation. Required, discuss the accounting treatment of the above.
So the first thing we need to look at is that the date of acquisition was 1st of January 2021, right? Useful life is 50 years, right? The next we need to look at is how many years was the asset used before it was decided to be held for sales. On 31st of December 2022, they revalued it to 1.2, right? It is not yet held for sales. But 2023, it met the held for sales criteria, and the fair value was deemed to be 1.1. So the first thing we need to do is to calculate what's the carrying amount. What is the carrying amount of these assets, right? To calculate the carrying amount of these assets, right? Cost is 1 million. Useful life is 50 years, right? Date of acquisition was 2021, if I'm correct. 2021, right? Cost to sales is 50,000, right? So the first thing we really wanted to do is to calculate the depreciation of these assets, right? So any other information? Fair value is 1.1, if I'm correct. 1.1. Revalue amounts is 1.2, if I'm correct. Right. Revalued in 2022. Revalued amounts in 2022. Right. Okay. So the first thing we really wanted to do is to calculate our carrying amount. So how do you calculate our carrying amount? Our carrying amount is going to be what is the cost. Sorry, to calculate our depreciation. That's the first thing we wanted to do. To calculate our depreciation is going to be 1 million, right? 1 million divided by useful life, right? Times 2. Times 2 years. Right? That means our carrying amount, CA, is going to be 1 million minus. That's our carrying amount, right? Does that make sense?
Yes.
But however, there should be a revaluation gain. on this asset. Do you agree? Because at the end of 2021, the asset was revalued. Sorry, at the end of 2022, the asset was revalued. It was in 2021, 2022. They revalued the assets, right? They did not tell us to calculate the value gain, no, but there's a revaluation gain on these assets. Revaluation gain or surplus. Our revaluation gain is going to be revalue amount, which is this figure, 1.2 in 2022, minus carrying amount, 240. Does that make sense?
Yes.
Yeah.
Yes.
The asset,
Sorry, because excuse me, sir.
yeah,
The gain is 240 because the carry amount became the opening balance for 2022.
the opening balance for 2023.
Sorry, 2023.
Yes. And the asset was held for sales as at December
Okay, by the first.
2023.
Okay, yeah.
We have not gotten to that. We are still going to that place.
Okay.
Does that make sense?
Yeah.
Can we continue? Another question? So this revaluation gain will exist in 2022, but we have not gotten to where we want to determine our whatever. So in 2023, right? 2023, right? That means our carrying amount should be how much? Should be 1.2 million. Does that make sense? That should be our carrying amount. This carrying amount was 2022.
It has been revalued.
Because it has been revalued. Carrying amount in 2022. These are carrying amounts in 23. Right? As at the beginning, carrying amount, let me put it there. Carrying amount as at the beginning of 2023. Right? Does that make sense? That means our carrying amount at the end of 2023, CA at the end, is going to be 1.2. It's going to be 1.2. I want to lock it. Divided by 48 years. Do you agree?
Yes.
Do you agree?
No, not clear.
No, that's not the carrying amount. So I'm sorry, that's not the carrying amount. The carrying amount should
That's
be
depreciation.
that depreciation. Sorry, that depreciation. That depreciation. That should be depreciation. Our depreciation for that year.
So okay, it was revalued to 1.2.
Yes,
So
was
that
valid for
became
1.2.
yeah, so that became yeah.
So that means these are depreciation for 2023. Does that make sense? So CA for 2020 at the end of 2023 is going to be this minus our depreciation for the third year. Does that make sense? Does that make sense? This is going to be our CA, carrying amount at the end of 2023, when the asset was held for sales. Do we all agree?
Yes.
So, what is our fair value? What's our fair value?
So
1.1 million. 1.1 million. That's our fair value.
1.1 million.
Yeah. And the what carrying amount is how much? 1.71 million, 1.75 million. So which one are we going to choose? Carrying amount or fair value?
Fair value.
Carrying amount.
Fair value.
Sorry, fair value 1.1. The other one is 1.7.
Yeah, 1.17 because the what? Because the carrying amount is lower. Does that make sense?
Yeah.
That is how you account for asset held for sales. So that's how you determine if there's cost of sales. You have cost of sales of 50 million, Like, sorry, 50,000. So you take away your cost of sales from the figure, either of the two, which will give us 1,050,000.
Please, can you copy and paste the fair value so that we can also obtain the valuation amount?
That's the fair value. That's the
Yeah.
carrying amount. Does it make sense? So the other thing we need to look at is disclosure requirements. I think summary. Okay, I think we look at disclosure requirements. Yeah, summary. So one of the things we need to look.
So what about the accounting entry?
What about the accounting
The
entry?
accounting treatment.
Accounting
The accounting,
treatment is very
yeah.
straightforward.
Oh,
So we
is it
want to
possible?
head this asset for sales. So what this one is saying that what should be the cost that we edit for sales is going to be the lower of cost or fair value. We have established in this question that the fair value is lower. That means the fair value is going to be what? 1.1 million, right?
Yeah.
Right? And we want
Yeah.
to add this asset for sales. If, for example, we eventually sold this asset, sales price is I want to put it 1.5 million. Right? So what do we do? Let me ask you the accounting entry. What do you do? Before we go there, let me ask you this question. Immediately an asset is classified or made the criteria for held for sales. Once an asset has made the criteria for held for sales, immediately we separate it from non-current asset. That is first you need to do. Once an asset has been classified for held for sales, you take it away from the current asset and you bring it down as a separate asset. That means we no longer calculate depreciation on it.
So it will be under current assets, Abi.
Exactly. It will be under current assets because it's now
So will
held
it
for
not be
sale.
tagged as head
Technically,
for sale as a line item?
there will be held for sales as a line item separately.
Okay.
So it's no longer a non-current asset again because it has now met the criteria of asset that is non-current asset. It's because it's now held for
Yes.
sales. It will be separated from non-current assets.
Okay.
So technically, you can say it's not going to be part of your fixed asset schedule again because it's not showing on your non-current asset again. Technically,
Okay. So will it be that it will be okay, how will you now show it on like excluding it from the PPE?
yeah.
Will it be a disposal? Will it be a write-off
It's not
or
a it's not a disposal yet. So that is what this standard is talking about. An asset has been classified as a non-current asset is now classified as held for sales, and it has met that criteria. So what value will you show it? Is it at fair value or at carrying amount? So whichever is lower between the two, that is the cost you show in your estimate of financial position. No profit or gain is coming around there. We are not talking about profit or loss on disposal. Profit or loss on disposal is not still coming. What this standard is talking about is once a non-current asset is now classified as held for sales, at what value should we show it in the book? On a separate line, separate from our non-current assets.
okay?
So we should state it at lower of carrying amount or fair value on a separate line. Separate line that I'm now talking about means current assets indirectly. But with description held for sales,
Okay.
because it's not an inventory, it's technically an inventory, but we don't want to call it an inventory. We are saying we have a non-current asset that is now being held for sales because it has met that criteria, because the company is committed to sell it. There's intention, they are making effort to sell it. Does it make sense? Basically,
Yeah.
technically, what we are saying is that company purchased a motor vehicle. We intend to use the motor vehicle for 5 years. Technically, might not be up to 5 years in reality. In Nigerian sense, might likely be 4 years. We want to use it for 5 years. Then after the second year, we felt like this vehicle is not meeting the criteria. It's not meeting the purpose why we purchased the motor vehicle. Then we want to sell it, and it has met the criteria, and we now say we want to dispose this asset. Is technically is not an inventory, but we don't want to call it inventory, but we want to call it non-current asset held for sales. But at what price should we now show it in our book that this item, we want to sell it, we are doing marketing, we are making efforts, we are looking for buyer to buy it, we are committed to sell this as this motor vehicle? What value should we show it? IFRS 5 is saying that we should show it at either lower of fair value or carrying amount. Now, I think the question you are now asking is that means it's in our book. It's just like we are taking away from our fixed asset schedule and taking it down to it. We are just changing the line item. The line item in the statement of financial position is changing. Now, if you now sell it, that means that is when selling price will come in. And when selling price comes in, I don't think that's an issue with that. Is that it comes we sell at a loss or at a profit, and which is going to impact on our P&L and also affect the non-current asset because we are going to credit non-current assets. Does it make sense? So if this particular asset now that the fair value is lower, 1 million, that means non-current asset held for sales is having a value of 1 million debit balance, because all assets must have a debit balance. If we eventually sold it for 1.5 million, basically what we need to do is just to credit this with 1.1 million, and the difference of that 40,000, you go to our income statement, other income. So there are two credits, right? Profit on disposal should be, I've not taken cognizance of cost of sales. Cost of sales is 50,000. That should be 450,000. So 450,000 comes here, right? 450,000 comes here, which is other income. Then 1,050,000 credited to this non-current asset held for sales, right? Then the debits, something's coming to our bank, right? Our bank should be 1.5 million. This amount, 1.5 million. Does that make sense? Does that make sense?
Yeah.
Because this comes to non-current asset held for sales. Non-current asset held for sales. Why this one comes to our other income? This comes to our bank, right? And I think everything should balance up. That's the accounting entry. Does that make sense, please? Aminat.
Yes.
Aminat, does that make sense?
So since you are moving into non-current assets, so what's going to happen to your fixed assets account?
Definitely, you are going. Definitely, there's what we call reclassification in your in a potential fixed asset schedule, standard one. This is how I like to present my fixed asset schedule. Where I said fixed asset schedule, I didn't say intangible. Me, I always like, let me just explain. I like to separate intangible schedule, asset schedule from my fixed asset schedule. Your fixed asset schedule potentially should have, let me say for example, I have motor vehicle, I have furniture and fitting, right? Right? Let me just use these two. This is what I will have in my fixed asset schedule. And that's how your fixed asset schedule should look like. You have costs at 1 let's say 2025, we're in 2025, right? What is the cost? Let's just say it's 20. Let's say this one is 10 because furniture should not be more than motor vehicle. Let me say this one is 50 potentially, right? Then do we have addition? Do we have reclassification? Reclassification. Do we have disposal? Then you now have your total.
What about revaluation? Still the
Revaluation,
same.
thank you. Sorry, thank you. Revaluation. Revaluation. My evaluation should come above my classification, but let me just put it there. Right? Then I have my total. Right? Right? So this is the asset. These are the, you can, this is the cost size, right? Underneath, I will have my depreciation side, and my depreciation will also have the same. Let me bring it down a little bit. All right, this is my cost side. Underneath it, I will still have accumulated depreciation, right? At 1,125. What is my accumulated depreciation on this particular one? Let me say it's just 10, or let me say it's 20. Maybe 2 years has gone past. Let me say this one is 2.5, right? I will now say the classification will still come in here as well too. Disposal will still come here as well too. Disposal will still come here as well too. Charge for the year. For the year, we come here. Then I have my total. Then I have my CA. I will say CA at CA at 31st. At 31st, this 2025, Abi. At 31st, 2025. At 31st December 2025. And I have my CA. I have my CA at 31st December 2024. Because I want to see what my CA as at end of last year and at the end of the current year. I want to see what it is. So what it means is that we are moving, as we are saying classification, we are moving away from this. If the asset is, let's say, motor vehicle, right? And the carrying amount is, let's say, 30. That 30 is coming out of here, right? And it's going to non-current asset held for sales. That's what it means. Because we are reclassifying it. We are not disposed. We have no disposal has come yet. Because if the disposal has come, then it's totally going to be zero. But with this, there might be other kinds of asset that is still there. But if it's a single asset, that means at the end of the day, it's going to be a zero asset. Does that make sense?
So can you explain why we are having a charge for the year? Come down.
That is the division of charge for the year. There may be charge for the year for this other asset. It's a line item, does not mean to be applicable. Your fixed asset schedule can have, let's say, furniture and fitting, motorbike furniture and fitting, computer equipment.
Okay.
Because we are reclassifying this, does not mean that this one might not be having classification. They can be zero, they can be zero, and so on. There might be evaluation applicable to maybe one of these assets. There may be evaluation of 3 here, and this one might not have evaluation. So because we are not charging depreciation on the motor vehicle, does not mean that we are not charging depreciation on other assets. Because we will not do salary schedule for just one single asset. It's going to be for
Yeah.
the group of assets. Does that make sense, please?
Yes, it does.
All right. I mean, not any question, please. Any question? Do we have more people in? Okay. So let's look at the takeaway. Takeaway of this standard. Takeaway of this standard. Classification criteria. The item is available for immediate sales in the present condition. Sales is highly probable. Management is committed to sales. The item is being actively marketed. You must be marketing for items to sell. The sales is to be completed within 1 year. Once the sales cannot be completed within 1 year, you take it back to non-current assets. Once you cannot complete the sales within 1 year, take it back to non-current assets, except in certain condition. If the sales is out of your own control, you cannot sell it within 1 year and is caused by something that is out of your control, or you have evidence that you have evidence to show that you wanted to sell the asset but you were unable to sell it. That is when you still classify it as held for sales. Otherwise, take it back. Then under measurement, we say lower of carrying amount of fair value, less cost to sales. Then presentation, they are presented separately from other assets in the statement of financial position. So once you have met that criteria, take it away from other assets, then take it away from other non-current assets and go and show it separately. Does that make sense? Any question? Any question, please? Any question?
No question from my side.
Okay. So my intention is just to go to IFRS 10 today. That was my intention. So even if you can't go far on IFRS 10, I think I will bring us up to speed on IFRS 10. Right? So Oga Moses, are you still there? Moses. No, I don't need to ask Moses. Have you done
Yes, sir, Mr.
IAS?
Batru.
Yeah. Have they done IAS 27? That is separate.
That's separate separate financial statements.
Statement. They have done
No,
it.
I don't think it's relevant for them. That's why I didn't
Yes,
take
I'm just
them.
asking. Yeah, I
No.
don't think they have. Okay. So I want to make reference to it. That's why I'm asking.
Okay.
So, but it's not necessary. It's fine. So when we are talking about IFRS 10, IFRS 10 is talking about consolidated financial statements. That's what IFRS 10 is talking about. Now, when we say consolidated financial statement, before we can think of consolidating a financial statement, something must have happened. There must have been a parent-subsidiary relationship. Parent-subsidiary relationship. And when we say parent-subsidiary relationship, it means that we have a company A and we have a company B. And company A has obtained control over country B. And one of the way of obtaining control over company B is by acquiring more than 50%. It can be 54, it can be 51, it can be 55, it can be 60, it can be 70. One management is dominating another management. Then IFRS 10 says we can have a consolidated financial statement. So because we are having a consolidated financial statement does not mean that individual company or entity are not going to prepare their separate financial statement. They are going to prepare their separate financial statement. Meanwhile, the group itself will now consolidate the activities of the other activity. And when we are saying parent subsidiary, or when we're talking about consolidation, let me also say let me tell you this consolidation. Consolidation just means addition. Now, the flip side of it is that what will happen in real life might be very easier than what we see in exam condition. Because in exam condition, you are just adding. There are some things you don't add. I will tell you what you don't add. You don't have equity. You don't have the share capital. You don't have it. You don't have the equity part of it. But every other thing needs to be added. If I'm consolidating at the end of each month, I do consolidation every month because one of my responsibilities is to prepare group accounts, group management accounts at the end of each month to the year. What I do, there's operation coming from Germany, there's operation coming from France. Oh, sorry, let me get my charger. Sorry. So sorry. So there's operation coming from Germany, there's operation coming from Czech, Hong Kong, France, and Italy. Each of them are individual entity, right? My own responsibility is to prepare UK accounts, management accounts, make it ready, available, right? And I'm expecting accountant from other region to send their reports at the end of this month and consolidate. Check, I'm fine. Consolidate, put commentary notes, add, and show movements quarterly, half-yearly, as they are moving up to the end of the year, right? So when we are now talking about group, I'm just trying to tell you that consolidation is just adding. It can be very more easier in practicality because private everything is on Excel. You can just add up. You can just put formula and you are dragging down. Some of them you are dragging, you are making sure your formula is right and you are moving it. But in reality, it might not be as this it will see in exam purpose, it might not be as it's seen in practicality, right? But let me say, when we are talking about, I'm just saying that consolidation means addition. You are adding, that's what it means. But when we're talking about group accounts, we can have a simple group and we can have a complex group. We have a simple group when we have A and we have B down, and A has 100% equity in B. That's a very simple one. It might not be 100%, it can be 70%. If it is 100%, that means it's only own. But if it's less than that, that means we have our NCI in it that we also need to account for. We can also have a case of a complex group. A complex group means that A acquires 60% in B. That make B a subsidiary of A, and A is the parent. B went ahead to acquire 80% in C. That makes C a subsidiary of B. Then C went ahead to go and acquire another percentage, more than 50, in D. That is, we call it vertical group. It can also be horizontal, whereby A is the one that has acquired more than 50 in B, has acquired more than 50 in C, has acquired more than 50 in D, and so on. So what it means is that individually, they are required to prepare what we call separate financial statements, and that is all covered under IAS 27. Why the group as a whole is also required to prepare what we call a consolidated financial statement. Consolidated financial statement means by adding. I'm thinking in my head, I'm not saying I will do it. Maybe by the time we get to the practicality, I will show you what happened in this case. I will go through the practicality, the theoretical aspect of it. I will show you in this case how I consolidate and show you to say this is how you consolidate in reality of it, adding together. So that's what we are going to be looking at. But before we can do that, there are some procedures. There are some, I'll call it big four. There are some things that you need to know before you can think of consolidating. Number one is to determine what is the group structure. And in determining your group structure, you'll be able to determine what is the percentage the parent company is holding, what is the percentage the subsidiary is also holding? That's the first thing you must always do. You must determine group structure. In the actual sense of it, that's why I'm always trying to bring it to practicality, what you can experience in practicality. In practicality, it can always be very straightforward. But don't forget, as an auditor, or I won't say as an auditor, basically it should be applicable to an accountant where there is no physical evidence, there is nothing. For you to be able to say yes, is a group structure, somebody must show you documentation. In audit, there's what we call sectoral study and sectoral audit. They must be able to give you document. You want to see present incorporation document. Has there been any changes between what happened this year and last year? So if there is a group structure, maybe 70% last year, and that group structure, ownership structure have changed, maybe to 80%, the only thing that you can use to validate that or for you to know is to say, can you give me your incorporation document for this year? You want to see the percentage, whether the structure have changed. So I'm just saying that on a norm, somebody can tell you by mouth to say, this is the parent holding, but you want to know what is the group structure. That's the first thing you want to know. The second thing you want to know,
Sorry, excuse me, sir.
yes, go ahead.
Sorry. So each year you are preparing the report, it is advisable to request for the corporate document.
That's the best thing, because there can be changes. There can be removal of auditors, directors. There can be anything that can change in the group structure, in the company, at the background. So whether you are an auditor, whether you are whatever, whether you are even an accountant, I think you should always request for that. I think for internal reporting accountants, there are some things we usually very face, right? Which is the fact that some decision might have been made without carrying some finance departments into, maybe they did not carry you along, but eventually that thing is still going to drag into your table. Because I always say that when it comes to an accountant, there's some people that we call reporting accountant, and there's people we call operational accountant. Some people who are just involved in daily operation. How does operational work, right? But while some people are reporting accountant, they want to say, okay, how should we report this figure? Those are the people that I think every organization should have what they call a technical accountant. A technical accountant is the person that will tell you, okay, company is telling you, we are trying to involve in this type of operation. We want to enter into a lease agreement. If you're a technical accountant, you are the one that will tell them, this is how you treat it. Even if you are not a technical, invariably, a lot of us are technical accountants, but some big companies have technical accounting units whereby they need to embark on a project. They go to the technical accounting department and tell them what's going to be the impact of this thing on our FS, on our reporting. And they will tell you this is what's going to be having impact. Impact in terms of this is how reporting, this is figure that is going to be there, and in terms of tax liability. Reporting accountant can tell you that. Right? So as an internal person, you are preparing financial statement, basically because there are a lot of things that goes through the face of the financial statement in terms of note, disclosure requirements, note to the account. You want to tell them the ownership structure. How many share, how many units does these people hold? What if there have been changes between what happened last year and what happened this year? The only way you can know, even as an internal person, internal accountant, is by seeing the incorporation document and see whether there are changes from what happened last year or what happened this year. And as an external auditor, I don't think nobody needs to tell them that. They will always request for it. It's part of the requirements. So, because if as an external auditor, I ask you, give me your incorporation documents, and you send it to me, and even if there is changes in the current year, and you show me the old one, I've actually passed my judgment, because as auditors are making judgments, and your judgment is based on available evidence. So even as an accountant, reporting accountant, you're also making judgment. You are making a decision. You are reporting based on evidence, based on information. So based on information that is available for you, allow you to make decision. So I always advise you to request for it. But directly, you might be in the know that there are changes. Indirectly, you might not be in the know, because at point in time, maybe they don't want you to know. But I think in terms of UK standard, most of CEO of, let me say, incorporated companies listed on the stock exchange are also a director. So it will be very difficult for the CEO, the CFO. Most of the CFO of a company listed on the stock exchange are directors. So it's very difficult for the CFO not to be aware that those changes are there. So even if the report gets to the CFO should have to say, no, there are these changes, and they should be able to tell you, no, just go and amend. But I think it's advisable for you to check.
Okay, all right. Thank you, sir.
Yeah. So considering that fact, that's the first thing you really wanted to do. You want to determine the ownership structure, the group structure. The second thing you want to determine is to determine what is the goodwill on the date of acquisition. What is the goodwill on the date of acquisition, not on the reporting date? Don't forget that there is difference between date of acquisition and reporting date. Reporting date is usually the end of the year, but in some cases, our date of acquisition and reporting date can be the same if the date of acquisition is at the end of the year or reporting date. But the goodwill we want to determine is at the what? At the date of acquisition. Does that make sense?
Yes.
The next thing we want to also to determine is to determine our what? Our non-controlling interests. We want to determine our non-controlling interests. We want to determine our non-controlling interests. That's the next thing we want to determine. Then the last one we want to determine is the group income surplus or retained earnings. What is the group retained earnings? Once you're able to determine, there are some other things that can be determined though that is necessary. But these 4 things I've told you, they are very key when it comes to consolidation. They are very, very key when it comes to consolidation. So I think by next week, I think I will only talk less. If I'm talking less, I think I just want to define what is control. Most of these things are things we have heard before, or some of the things we have discussed either under business combination or other standard. So we are just going to be talking less under that by next week. One more thing, just keep my mind. One more thing. I think I don't know whether I said it. You don't consolidate equity of the subsidiary. When I say equity of the subsidiary, the share capital, share premium of the subsidiary, you don't consolidate it. Does that make sense? You don't consolidate the equity of the subsidiary. Does that make sense? Any question, please? Any question?
Okay. Yeah, I have a
So
question. So, can you
yes,
hear me?
please do.
Yeah. So, does it mean
Yes, I
that,
can.
yeah? So, so after adding the line items and those key things that you said we should do, so you now said in balance sheet we should not consolidate the equity of the subsidiary. So, which means that it is the equity of the parent company that will now be on the group
Exactly.
FX, right?
Yes.
Okay.
Yes, definitely. It's the equity of the group that is going to be. But when we are talking about consolidation, do you know we are going to be consolidating 3 items? We are going to be
Okay.
consolidating statement of financial position. We are going to
Yes.
be consolidating the profit or loss. And we are
Yeah,
going to be
no, yeah.
consolidating the statement of cash flow.
Okay, the
So
cash flow.
yes, the cash
Okay.
flow.
Okay, so the amount of
Cash
trading
flow,
equity will be that of the parent company
parent
that
company.
will
So
be
what,
there.
what we'll be working through by the time we started is how do we consolidate all of them? But I will start from the statement of
Okay.
financial position. We work through to the
Okay.
P or L, then we work to the cash flow.
Okay.
So we are not just consolidating the balance sheet only or the statement of financial position. We are consolidating the statement of financial position. We are consolidating the profit or loss, and we're also consolidating the statement of cash flow or cash flow statement. Does that make sense?
Okay. Yeah, that's noted.
Okay. Another question? Another question? Another question, please. Is
No question from my side.
like Sandra is busy today. Then one more thing, right? For people that are in tax, right? For people that are in tax, right? I actually talk about separate financial statements that individual company is required to prepare a statement, separate financial statement, right? The individual that prepare the separate financial statement are liable to pay tax on their individual financial statements. The group does not pay tax on the group account because that is double taxation. Does that make sense?
Okay. Okay.
We have A, B, C, D, right? A, B, C, D are prepared their individual separate financial statements. The A, B, C, D are liable to tax. What we are doing in the group account is consolidating the group activities. And the group activity is not liable to pay, the group itself is not liable to pay what? It's not liable to pay tax because we have separate financial statement. Each of them are entity on their own. Then secondly, when we are talking about consolidation, we are talking about consolidation between one entity and another entity. That means an entity, when I'm talking about entity, I'm talking about a company, acquire equity in another company, not individual that acquire. An entity can acquire 70% in another entity. They are still remaining 30%. That 30% can be owned by entity, another entity or other individual. But when we're talking about consolidation, we're not talking about consolidation of individual activities. If it is an individual that acquire majority interest in another entity, we are not doing consolidation because consolidation does not refer to an individual. We're talking about an entity here, which is a company, acquire majority interest in another company, not an individual that acquire majority interest in a company. No, you are not doing any consolidation. So it must be between two entities. Does that make sense, please?
Yes, thank you.
Okay,
All right.
so who are you presenting the consolidated report to? Who are you presenting to? Is it internally or externally? Since you are not paying tax, are you not using it to
Both.
go and bill?
Both.
Okay.
So for people that are still in tax, right? I will still go back to the people that are still in tax. We have what we call transfer pricing, right? We also have what we call country by country reporting. They are not the same thing. Abi, are they the same thing?
Yes.
No,
No, they're
They are
not the
not,
same
no,
they
thing.
are not the
no.
same thing. We have transfer pricing. Transfer pricing is a scenario where we have, let's say, Zenith. I want to use Zenith. I don't want to say Zenith Bank. Or don't let me use Zenith. Let me use First Bank Group, right? Under the First Bank, you have some other units there. You have the First Insurance. You have the First Bank itself. We have the first Shigo, or what do they call it? Is it First Ego or Shigo? You have other entity between it, right?
Let's see go.
Is it First Ego, right?
Let's see go.
Let's Ego. Yeah. So we have the Let's Ego. You have the insurance. You have the bank. You have the mortgage arm of it, right? And we have the First Bank Group, right? So these individual units, First Bank, Let's Ego, First Insurance, they
Let's
are
see go. FBN mortgage,
FBN mortgage.
FBN insurance,
There are so many units
FBN asset
underneath.
management,
Asset management is
FBN
still there.
pension.
That the same
Um,
thing is also applicable to Stanbic IBTC. You have the
yeah.
Stanbic IBTC Bank, the mortgage, the insurance, the CIS. All of them are individual entity on their own. So the question is that why do you need to prepare? Why do you need to prepare the group? Some people does not invest in the individual entity; they invest in the group, right? What if I buy shares in the group? If I buy shares in the group, I want to see the performance of other entity under the group. I want to see what the other entity are doing. So in terms when it comes to tax, whatever tax aspect of it, there is a transfer pricing unit of it. Transfer pricing, and transfer pricing is saying that at what price within the entity, within the group, at what price are they exchanging services. So let's say, for example, First Bank want to carry out insurance. Will it go to Zenith Bank? It will not go to Zenith Bank now. If you go to First Insurance now, and to conclude that kind of transaction, it's just the MD of First Bank calling the MD of First Insurance. We want to carry out this insurance and this thing. At what rate are you giving us? So what transfer pricing is saying that it must be at a fair value at an arm's length transaction. So you must have a transfer pricing disclosure at the end of each year. There are other criteria. but I know bank will meet that criteria in terms of your revenue. So that reason why you should also do that. So I'm even telling you in terms of when it comes to tax, which will actually transfer pricing part of it. So say, at what price do you transfer item? Is it at arm's length within the group? And we still have the country by country reporting, where is not even has to do within just Nigeria. You have to do by other parts of the world. You have transaction, we have other entity in Nigeria, and we also have other entity abroad. Just in context, but it is not applicable. Let's say, for example, let's say PwC, but it's not applicable to PwC because PwC is not a limited. Is a business name. So PwC does not pay company income tax.
An LLP.
Yeah, they are LLP, so they don't pay company income tax. But let me say, for example, PwC is in basically all over the world. And we have PwC in UK, you have in US, you have in Canada, you have in other Bahrain, you have in the Middle East. And PwC in, let's say, UK has a particular activities or clients or certain thing that they want to do in Nigeria. Do you think they will go and call other firm that is their competitor? They won't. They will just come to PwC in Nigeria and tell them, we have this client that is based in Nigeria. Can you advise us how to do this thing and this thing? They will give that. They will actually contact them. I'm just trying to use that thing, but I'm saying in this case they are not applicable to PwC because it's not a limited company, and they are, as far as Nigeria is concerned, it's not a limited company. They are registered as LLP because they are firm of professionals. So, but assuming it's a company, you know, in terms of tax aspect, they want to see how does that transaction goes, what transaction can transfer between PwC Nigeria and PwC UK in terms of certain dealings. That is when country by country reporting comes into play. So that is why people definitely will be interested in the activity of the group. Does that make sense, please?
Yes, yes.
So I think by next week Saturday, we said, do we say we should remain by 8, right? 8 Nigeria time or 7:30 Nigeria time? I want to register in my brain. What time did you agree?
Nigerian time is 9 o'clock.
Nigerian time is 9 o'clock. Thank you.
Yeah.
Can you also do me a favor? Which standard did they do first? Do you do first? When we started the standard, which standard did they do first, Oga Moses? Which standard did they do first, Oga Moses? Anybody can answer the question now.
Okay, IFRS 8 and 24.
IFRS 8. Can you do me a favor? By that next week, IFRS 8. Can you?
Let him confirm it. Let him confirm it.
That is business. That is operating list. Will you be able to complete this e-learning and get the certificate by next week before we come to the class? E-learning say you need just to commit 1 hour, but I know you need to commit more than 1 hour.
Okay, I'm trying.
Can you get the certificate when you are coming by next week and show me?
Okay, we'll try. I will try.
I mean, not is that a done deal?
I'll try.
Sandra, is that a done deal? Sandra, like Sandra is very, very tired though.
I'm here.
Is that
I
is that
don't
a deal?
understand. We need to clear.
Hello? Your network is
The
glitching. Is it my
e-learning,
network?
right?
Yeah, so before you came, I was just showing. Can you see my screen? Can you see my screen?
Yes, I can see.
So I said there is a
Yes, I
platform
can
that
see us.
yes, I said there is a platform that you can also learn 1 or 2 things. Like my Oga Moses just told me to share it with you. So it's just an add-on. So it is called IFRS e-learning. So the IFRS e-learning is owned by Deloitte, right? And it has basically
Okay.
all the standard it needs, all the standard. So
Okay.
if you go to that IFRS e-learning, whatever standard you want to test yourself on, just type it in this search button. So once you start it in this search button, let's say you go to IFRS 5, right? And you click enter, you can see it's giving me all the standard, even the one that is not 5. So let's say, for example, we are in, let's say I want to test IFRS 9, financial instruments. I'll just click on this launch. So before I click on that launch, I think it's telling me I needed to commit 1 hour 30 minutes to complete it's not
Okay.
time bound though, but it's just saying that the minimum time you need to commit yourself to be able to study this thing is 1.5 hours. So once you click on this launch, it will bring you to this
Hello,
page.
are you showing us something?
So it will bring you to this page. So you can see IFRS 9 financial instruments, and the part 2 of it is the recognition. So when you click on the next, it's telling you if you are very sure of yourself that you know IFRS now very well, just ignore everything, just come to assessments. If you click on this assessments, right? Is it my internet? Because I don't know what's wrong with it these days. If you click on assessments, so assessments, I think the one I illustrated because I've done those ones. Let me go to. If you just click on it, it will give you like overview. It will tell you, say, introduction to IFRS 9, scrutinization, moving down
Okay,
tree.
sir. Which of the IFRS do you want us to do? Everything.
No, I didn't say everything. You can't do everything. So I said you should do IFRS 8. They said that the first one you did, IFRS 8.
Okay.
So can you finish it by next week and come with the certificate by next week? Because at the end of it all, it's going to be giving you certificates. If the pass mark is 70%, I think I showed you the last time. I don't know why it's not giving me the assessment. Thank you. See, this if you come to assessment, that's the assessment. Can you see my screen? Can you see my screen?
Sir.
So he said, congratulations, you have now completed IFRS 8 operating segments and are ready to take the assessment. There are 10 questions that can cover material from any of the areas. You need to score at least 70% to pass. If you pass the test, you'll be able to print a certificate that documents your successful completion of the unit and your score. So on the certificate is going to show how much you score, and it's going to also award you a certificate. So before you start, put your name here as you want it to appear on the certificate. So once you put your name here and you click on next, then you'll be able to start attending the assessment. So if you don't score up to 70%, you will not be able to pass, and you'll not be able to give you the certificate. But once you score 70 and above, they will award you a certificate, and that certificate is actually issued by Deloitte, and it will tell you have completed this. So you have almost all the IFRS standard there that you can go ahead and complete. But because you have done IFRS 8, I feel like it's a way for you to say why you have been involved in this training. You have one certificate done, completed, and also give you a level of assurance how far you have gone on this course. So I'm asking, is it a deal that by next week Saturday, you come with the certificate? Is it a deal?
There's
Yes,
nothing
boss.
God cannot do. We will do it, sir.
There's nothing God cannot do. Yes, there's nothing God cannot do, but this one, you have to commit yourself to
So
it.
we'll do it.
We will
Yes.
do it. Don't worry, sir.
So you come with
Just
certificate, Abi. So another thing I told them is like it is a multiple attempts. If you do it the first time you did not pass, you can reattempt. But the question is that don't expect to see the same question in several attempts. If you attempt it 5 times and you did not score to 70, you are not likely to see the same question in all the 5 attempts. I can guarantee you that one. Unless that standard is a very small standard and they don't have details there, they are likely to have the same question. But you are not more likely to have the same question. That one I can tell you 100% is an absolute assurance.
okay, sir.
All right.
Okay,
All right.
sir. No problem.
All right. Thanks everyone for having me and sacrificing your time. I know it's past 10 in Nigeria, and so people are actually going to work, and there's still family commitments.
Thank you so much, Mr. Badru.
Thank you,
Thank you so
sir.
much, sir. Really appreciate your time for this thing. I
Thank
think this, Mr. Badru, do you still have any class next week, sir? Or this?
Yeah, if you want somebody have another class next week, Abby.
I'm not sure. I don't even know. I don't know if this is the last class or you have more class. I'm trying to think.
Basically, the class I have is just to take this IFRS 10 and take the social
Okay.
planning.
Okay, yeah, that's
But,
true. That means next week. Okay, yes. So
but
that
I don't
which
know whether
means
somebody is having a class.
no, nobody's having a class. I think I'm the one. I'm supposed to take that financial what's it called? like
Preparation of
the prepare accounts from source document.
okay.
So maybe what we'll do is maybe when we take that on Saturday, I'll take that source document and account on Sunday.
Okay.
But I
Okay.
think you're taking
Yeah.
IFRS and disclosure, right?
Yeah, see, I'm
So
taking just 10 and disclosure. I can take the
okay,
other
that'll be
two.
Saturday morning. Okay. Then
Yeah.
while I'll take the account, so which means we've speed just for every other person, we've speed off. I'm supposed to have been taking auditing by now, which means we've speed off time. But me, I'm going to stop at the time we agreed though, because we are moving. We spent more time on accounts and also on Excel. When I was taking Excel, we spent some time on Excel. We also spent some time on accounts now. So auditing, I don't know how we will do auditing now. That's the time. That's the thing. Because when I go into auditing, I don't know. Except maybe we will pick areas that we feel I should take us on auditing. Except that. So maybe except we will do that. But if I'm to go into auditing, revenue testing, existence, occurrence, and all of those things. So anyway, we'll get there when we cross that. But I know by November end, which is like because once we do next week now, we have like more like 3 weeks more in November
Yeah.
to go. So I don't know how I can take auditing in 3 weeks. So that's what I do not know. Said I'll just rush it. Because from those take sessions and all those things, then go into testing. But what do people think?
Yeah, you can watch it and it is good during the week.
I'm struggling, sorry. I'm struggling to hear you. You said what? Hello?
Oh, can you hear me now?
Yeah, I can hear you now. You said what?
Hello?
Yeah, I can hear you. I can hear you. What do you say?
Can you hear me?
I can hear you. I can hear you. You can go. You can
Hello,
go.
can you hear me?
Yeah, I can hear you. But you want to stay there.
Yeah, I said probably you will just rush it.
Okay.
Since it's
Maybe
just a bit of story now, right?
oh, this is
Or
not
you
story. Oh. All this is
or
not
you
Audit is
have
not
story.
a
story, oh. Audit is
and you
details, oh.
then
Hey,
another thing is you can prepare a material for us to study after your the rush or something. If it's something that is well explained,
all this is
that we
even
can take
technical
as
than all this
Technical
accounting
than
you're doing
all
now.
these ones. Even determine your materiality, you need to determine your
It's the record that all this what you're doing now.
The testing and then all those things. So something that. Well, let's see how it goes anyway.
yeah.
Sunday, next week Sunday, give us the preparation of the financial report from statement and source document and all of that. Why he's taking the consolidated on Saturday and the other one too.
Okay, no problem.
what I can
Yeah.
assure to do, what I can assure to do is that I will make sure even the time is going to be extended on that Saturday. I'll make sure I finish up everything on Saturday.
Okay.
Even if I have to spend 4 hours with you, even if you have to go for a tea
And
break,
you people can carry 4 hours.
why can they can't carry 4 hours?
I'm
Even if they
just
have to
asking.
take, if they can't, you have to take a tea break. I'll make sure I round up on that Saturday.
I think it's better like that to extend
Yeah.
the time.
So even if you have to do 2 hours, I just give it 10 minutes
But
each.
you have to consider the person taking the class too. It might not be convenient like that. It's to stay
No, no,
talk
no.
for 4 hours.
I've just given you my word. I'm committed to finish it off on that Saturday.
Thank you, sir.
So even if you have to me taking like a kind of a tea break,
Emma wa kete kete cool.
no, because I think I'm the one that's even making it like behind because last week Saturday Sunday I think I was not available. I'm very sorry for that. One of my friends came from Canada and we just have to catch up and it was going back on Tuesday. So I
So,
know I'll be out late.